Sarah, I want to start here and just get macro just for a little bit. What we did not see, what we did expect, what we expected was a synchronized global recovery in the first part of this year. What we didn't get was exactly that. Then we did get some dollar strength to go with that. And Sarah, I'm wondering whether that's largely played out now, whether we start to repair some of the damage done in the first quarter as the year progresses.
I don't think we're quite there yet. You're right. We had hoped for this synchronous global recovery until we can get some of these vaccines outside of the U.S. to catch up with the populations. We still see that there'll be struggles outside of the U.S. U.S. market returns will probably be stronger than the rest of the world. Dollar more likely to be strong. But longer term, we are still fans of emerging markets. Areas such as Latin America, pockets of China, and even India will eventually catch up. Their markets will look much cheaper on a valuation basis, and they have the strong structural growth of that rising consumer. So long-term positive on emerging markets. Shorter term, we still think it's an asynchronous recovery where the U.S. tends to outperform the rest of the world because of the dollar strength.
Keith, what's your take on that?
Yeah, we've been overweight the U.S. for some time. And really, if you look at the outperformance, it's because the earnings are so much stronger. If you really look around the globe, the U.S. economic upward revisions are the strongest in the globe over the last 3 months. And you've seen estimates come down in Europe. So we would stick with that trend. I will say, going back to the global recovery, it is very uneven. As you get back to the second half, as we start to see hopefully better COVID numbers around the globe, that should help bring back yields back up and support the value trade. But that's part of also the reason why I think we've seen that pause back in that value trade we talked earlier. But for now, we would stick with the U.S. Look potentially for an opportunity later in the year because expectations are low in Europe, but we think it's premature at this point.
Is dollar resilience something that persists? Can you just build on that, Keith?
Yeah, coming into the year, and I remember, Jonathan, we talked about this early in the year, that almost everyone was negative on the dollar, and the dollar has been actually very stable this year. We expect stability to continue for the U.S. dollar. Again, as the COVID cases hopefully improves in the back half, we could see some room or some scope for the outperformance of something like the euro. But at this point, with the better economic numbers domestically and the interest rate differential, where the U.S. yield, even at 155, compares to a German Bund at a negative 0.3, we still think that's supportive of the U.S. dollar.
I caught up with Chris Verone this morning of Strategas, who was talking up European autos. Saira Malik, just a final word from you on that, on the situation in Europe. Most people believe that that's got a lower bar. It's a source of upside surprises. Yields can rise and equity markets can outperform.
Valuations have been in Europe's favor for a long time, but we really need that catalyst. We could see a lost summer in Europe in terms of travel. I think it's going to be tough for Europe to perform from here on out, and also over the longer term. Global autos, we do think are interesting once they overcome the chip supply issue. We think there's a lot of interesting upside for global auto companies, but that's because they tend to be more, they're not just European based, they tend to be global, and that sector in itself, I think, can have strong demand, low inventories going forward, and people using more and more private automobiles. But Europe, we think it's going to be that same story, where what's the catalyst to really take Europe higher from here at this point? Probably not through this summer. I don't think Europe's going to be the outperforming region.